Hi, and welcome to episode 2 of the Larch Fund. This is my portfolio update video. It's the second month of this portfolio. My name is Liam, of course. Welcome back to Golden Arch Investing. And today we're talking all about what's happened over the last month, what new stock is getting added to this portfolio, why I'm picking this stock, why I think this is a good option for this portfolio, why it fits. And then we're also going to talk a little bit about what SPY, the S&P 500, is doing in my Canadian dividend portfolio and why it makes a lot of sense in a risk management mindset. So last month in our first video, I mentioned what exactly I planned to do with this portfolio, what the purpose was, what was going to go into it, what I wanted the allocations to be set at. So I talked about adding banking, which is a huge Canadian sector. I talked about natural resources. I talked about wanting investments in the United States. We put all that together, and that was the video. Now this month I get to tell you I've actually bought the stocks. So I have everything moved into a portfolio that I'm tracking here on Snowball Analytics. And I'm adding a new one this week. And it's one that I've talked a lot about. So first and foremost, what new stock am I adding to my portfolio and why? Well, in a move that might not surprise many of you, I'm adding Canadian Natural Resources, or CNQ, to this portfolio. Just last week, we made a video talking about their acquisitions in the Canadian oil sands and talking all about sort of their position as this big, strong player that, like them or not, seems to be consolidating a huge portion of that Canadian market. And that makes them a pretty obvious choice if you're looking to buy somebody who is actively making a lot of income, is returning a lot of that income to shareholders, and who's in position to continue to grow and expand through acquisitions in that environment, regardless of if oil is going up or down. One of the things I didn't really have a chance to talk about, though, in that video was why this company? What makes them a worthwhile investment compared to all their other energy peers? And why am I picking them to go into this portfolio that is based on a long-term dividend growth strategy? Well, in order to do that, I decided I was going to break this company down and sort of analyze them in this video and explain to you why I'm buying this company. So we're going to do something called a SWOT analysis, where we'll talk about strengths, we'll talk about weaknesses, we'll talk about opportunities, and we'll talk about threats. And we're going to start with strengths. So what is it that Canadian Natural Resources does well? Well, first is their strong financial performance. These guys have been routinely increasing their cash flows year over year, and they've been able to return more of that in free cash flow to investors. One of the best signs that they've been able to do this is their consistently growing dividend, which has shown that they've been able to consistently raise more money, earn more, have more free cash flow that they can then pay back to their shareholders, which then allows them to have this consistency, this strength on their balance sheet. They've shown strong, consistent performance. And they've been able to do it through all sorts of environments, which gives me the confidence that over the long run, even if there are serious challenges for oil and gas companies in the near future, they will probably continue to return balance sheet strength and therefore dividend growth to me as a shareholder. The next big strength that I wanted to outline in this video was their assets. They own an insane amount of oil generation potential. They have so much oil in the ground that they have the rights to, that they could continue operating functionally forever, or at least as long as I care about for this portfolio. And they have so much that they would be able to pick and choose their moments for extraction in order to maximize profits in the future. This gives them another sense of flexibility, that they would be able to make it through real challenges, which again is what I'm looking for in a company like this, because it means that they'll probably make it the 25 or so years that I'm hoping to hold this portfolio. They also have a unique ability, thanks to their strong amount of asset base, to leverage that asset base and use it to make more and more acquisitions, as they've already done. They've shown they're willing to step out there to find good opportunities and purchase them, and I believe they're going to continue that strategy, which also gives me a lot of faith that they will continue to grow in at least the near to medium term. Well, just like they have these big strengths, they also have some big weaknesses. And again, I'm going to talk to you about a few of them. And the first, and I think the most obvious one that goes for basically all oil and gas companies is their dependence on one commodity, which is crude oil. And sure, yes, they do lots of natural gas as well, but really the asset that holds their future is crude oil. If this asset isn't needed, if there are some huge technological changes in the near future and crude oil is no longer required on the level or even a similar level to what it is today, this company's in real danger. Now, one thing I do want to mention when I talk about this weakness is that would go for any oil and gas company. So when I'm sort of comparing it to the field, I don't really think I could hold that against CNQ. Any oil and gas company obviously depends a lot on the price of crude oil. And just because this company doesn't mean that it's worse than the others. A second weakness here is this company's reputation. And I need to be kind of careful while I say this because I don't want to say anything that's sort of insulting to this company in a way that might get me in trouble. But I have heard feedback from lots of people in the audience who say that either CNQ is sort of not investing into the safety and the conditions of their workers. So people have said, hey, I've worked on these sites. They're either, they say poorly managed or dangerous or gross, right? People have said negative stuff about working there. I haven't worked on a CNQ site, so I'm not certain. And second, they've also had some sort of bad reputation for their environmental practices, neither of which is a good look. And it means that there's a potential that at any point in the near future, there could be a big story of some horrifying thing that CNQ managers have allowed to happen. So either somebody's been seriously injured or they've made some huge ecological disaster or whatever that could potentially happen. And as an investor, you have to recognize that that would be seriously damaging to your investment. Our third category is talking about opportunities. And here, this is really why I'm investing in this company, is because they have so much opportunity to return money to me as an investor. And I think one of the biggest opportunities they have is to become the key brand name big company in Canadian oil and gas. And that's even assuming we don't consider them the brand name right now. But they just have this potential to be an absolutely dominant force in this marketplace. And while dominance and having one major player in a marketplace might not be great for competitiveness and could allow for people to slip, it also usually allows for margin expansion. Obviously, it's going to be a little bit different because they're not the only oil and gas company. They're just sort of the dominant player in this specific corner of oil and gas. But it could lead to them having better economies of scale or just otherwise better able to turn a profit and bring that profitability ratio higher, which would mean that more money is probably returned to investors or is invested into other projects. Speaking of investing into other projects, another huge opportunity I think they have is to take the huge amount of cash flow they have right now and turn that around and put it into renewable energy. And I know a lot of people that invest in oil and gas stocks always hate when people bring up renewable energy and how these companies that are these big oil and gas energy companies could theoretically be investing into renewables. And people say it's not necessarily going to be accretive. It's not going to bring money into the firm in a reasonable time frame compared to investing in more oil and gas. The thing it does do, however, for me as a long-term investor, is it allows both the company to sort of argue that, hey, we are in a position where we can survive even if oil prices go down, or if the oil market's shaken up, or if Canadian crude isn't required, or if there's more discovered somewhere, or whatever. It says, hey, look, we can continue to deliver. We have another resource that we can continue to deliver on. And it allows them to ask for a higher multiple because they're saying, hey, look, we're no longer taking on such a huge amount of commodity risk. And so our company is more likely to succeed in the future, which might allow investors to give them a higher price to earnings ratio. It would just mean basically that the company's stock price could be sort of not so tethered to the price of oil, which could be a really good thing for me. Now, the final category here is threats. And I think this is really huge for somebody like CNQ. And when I'm talking about a threat, I'm really thinking about what could happen immediately that would have a huge impact on this stock, this company, this investment. And I think the first one that you have to talk about is the threat of innovation. Anytime you're talking about a company that is so dependent on a resource like oil that theoretically people are trying to get rid of, there could potentially be a huge technological innovation that means that oil is no longer required or isn't required in the same quantities, or that makes the price we pay to extract Canadian crude oil no longer reasonable compared to what other producers can make it for. Think about what happened with fracking in the United States, when all of a sudden it was so much cheaper to get oil very close to where we produce so much here in Canada for a much lower price. The price of oil collapsed, and a lot of Canadian companies did not recover. If there is another similar or even greater technological innovation, it's really, really reasonable that this company could be damaged permanently. There's also like theoretical innovations like nuclear fusion. Somebody cracks that, and all of a sudden energy on Earth is this easy thing that we can have in abundance. Well, they're probably no longer willing to dig up quite as much tar sand and extract oil from it, right? So there is always that sort of risk. The second and maybe more controversial threat here is one that's actually been talked about here in the news in Alberta recently. Our premier, the leader of our province, has sort of made a big fuss about what they call the emissions cap, or the oil cap, where the government of Canada is theoretically, I'm not certain that this is actually happening, but theoretically going to cap the amount of emissions that is allowed to be made by the country, and therefore would say, hey, no more expansion for companies like this, because now they're not allowed to drill more because that will release more carbon and so on and so forth. And basically that would just absolutely kneecap a company like this. Now, I'm not super well informed on whether this policy is going to happen, or if this is something that is being used as sort of a political tool by either the federal government or the provincial. I don't know. This is not a political channel. That's not what we're focused on. But it is important to note that theoretically, any government at any time, as long as they had enough political will, could absolutely end this company. If a Canadian or even an Alberta government decided we don't want these companies to be continuing to drill for oil, or to be allowed to do the things they're currently allowed to do, or to be allowed to have pipe, or whatever, they would be able to say, yep, you're done. And because this company is so focused in Canada, it only takes one government to end them. And so it's an interesting thought. I think it's an interesting threat that theoretically the government itself could be a threat to this company. And that more or less concludes my overall analysis of this stock. I think there's some really strong strengths, some things they've demonstrated they can do well. There's some weaknesses that are shared, a lot of them amongst oil companies, but also theoretically could present some real threats in the future. They have some opportunity to become a dominant player. They have the opportunity to take advantage of changes or shifts in the market, or make them themselves. And there are some serious threats that might disrupt their whole industry. But I think one of the reasons why I'm picking this company is because I think the strengths and the opportunity of them being the biggest player is more important to me than the weaknesses and the threat that sort of would impact their entire category. I don't think investing in a Suncor, I would have a very different analysis of their weaknesses or threats. But I might argue that they haven't demonstrated the same kind of drive to become dominant that CNQ has. Now, I'm not saying that I wouldn't invest in Suncor. I just haven't looked into it enough yet. But what I am saying is that a lot of these threats and these weaknesses apply to the whole industry. And therefore, I think the strengths outweigh the weaknesses. And I'm willing to put in a little bit of money. Now, I think it's important that I say this is not going to become 100% of my portfolio. And I'm not somebody that would invest 100% in any one category, because that would be really poor risk management. Speaking of which, that's kind of what we're talking about in our next little segment here, where we talk about why my portfolio looks the way it does. Now, I should have the tab from Snowball Analytics to toss up on the screen here, but you should see that a large chunk of my portfolio is held in the S&P 500. Now, this portfolio is supposed to be my Canadian dividend growth portfolio. Why is such a big chunk? Almost 40% as of the recording of this video, but might be a little bit different by the time the week wraps up. But why is this big chunk of my portfolio invested into the United States? And that all comes down to risk management and geographic risk. I've been thinking a lot about this over the last little while because I have focused so specifically on Canadian stocks. And something that most Canadians know is that our companies are tiny and not very efficient in contrast with a lot of their American competitors. There are American companies, think about the earnings over this last week with all of these massive mega cap tech companies, but there are companies in the United States that just make more money easier than most Canadian counterparts. And I do own lots of American companies in my own personal non-registered accounts. And I think it's a good idea, honestly, to invest in the global economy. But one thing I wanted to do with this portfolio was focus on Canada, but still make sure I am thinking about the future. I'm being reasonable and logical, and I am putting myself in a position to not be entirely dependent on a few sectors. In Canada, financials are such a huge component of our overall economy. Natural resources are such a huge component of our overall economy. So energy stocks, it's very, very difficult to risk manage your way out of that and stay in Canada. Because if the price of oil collapses and so energy companies collapse, that's obviously going to impact my financial investments. If these banks are loaning to these companies and all of a sudden these companies start collapsing, these banks are screwed too. And I think that's an important thing to think about as an investor, particularly a Canadian investor who lives in a smaller economy. And I'm sure this applies the same if you're a Brit or if you're German or Japanese, right? And you live in any of these sort of non-US economies and you're thinking about, okay, well, I do want to invest at home, and there are big incentives. As a Canadian, there's huge dividend incentives to being invested in Canadian companies, and I'm sure there are similar incentives in lots of countries around the world. But while you do want to be invested at home, you don't want to miss out on the growth of the overall economy, and the best way to make sure you don't miss out on the growth of the overall economy is to own it. Is to own the S&P 500, the biggest 500 companies, and just let it ride. And I do think that there will probably be a time where I'm investing in specific American companies, because just like in Canada, there are going to be some that outperform others, obviously. But I also think that because I'm using this really as a risk management hedge, I do want it to be a big source of diversification for the portfolio. Geographically, yes, so getting me a little bit of exposure to out of Canada, but also sector-wise, right? A huge chunk of the S&P is technology. For a lot of people, owning the S&P as a way to diversify away from American companies doesn't work that well, because so much of the American companies are going to be technology. But for a Canadian, where my biggest investments are in things like financials and energy, well, having some technology is actually a great way to diversify. There's also other companies in there, right? Industrials, these big players, American financials who finance the world, right? Who make the scale of somebody like a Royal Bank look actually kind of small. So it just really does offer me a huge amount of opportunity that I don't think I'm able to get without investing into a US broad market ETF. I just think that's the best way for me to work out that sort of geographic and diversification problem. But if you disagree, if you think there's a better way, if you think I should be investing into a Dow Jones or a NASDAQ, or if I should maybe be partitioning into all three, please let me know. I also want to know your thoughts about CNQ. Do you think I've sort of misread this? Do you think there's another company that fits that same sort of oil producer that I should be investing in? Do you think I shouldn't be investing in an oil producer at all? That there are other Canadian companies that offer a much better return on investment? Because a big part of this channel is learning as I'm going along and sharing that journey with you guys. And so I always want to hear your thoughts. Anyways, over the next week, you're going to see on Blossom that I'm adding the CNQ shares into the portfolio. I'll probably do a purchase or two, depending on how the week's looking. And if there's any like jumps or anything in the price. Obviously, Tuesday this coming week is a big day. And I think we're going to do a video talking about that pretty soon too. So look out for that. And if you have anything that you want to share with me or you want to ask me about, please drop that in the comments below. With that being said, if you made it this far in the video, please leave a like and subscribe. We're making videos every week. We've been a whole bunch this last couple of weeks, which has been awesome. And we're looking to continue just growing, investing in Canada, and learning about the stock market. That being said, have a good one.